are continuing our breaking news coverage of the Bank of Canada rate decision, maintaining rates at 5%, saying it looks like rates where they are right now are enough to snuff out excessive demand. In fact, the Bank of Canada saying that they believe that that excessive demand has already come out of the system. But with rates at these levels, one of the most interest rate sensitive parts of the market has been housing. We've certainly seen signs of a major slowdown. In the past couple of days, we've got data from Toronto, Vancouver, Montreal. Sales are getting clipped. Prices are getting clipped. Let's bring in Barry Fenton, President and CEO of Lantera Developments, and Earl Davis, Head of Fixed Income and Money Markets at BMO Global Asset Management. Gentlemen, great to have you back on the desk.
Nice to see you.
Look at this. We're starting out so friendly. Doesn't always happen on this show, especially on Bank of Canada Day. Let's talk about the slowdown, the housing data that we've seen. I know you do condos, but you've got your pulse on it. It seems like it's finally starting to gather, right? That slowness.
They're doing the job that they've asked us to look at. So yes, there's no question that the market and sales have slowed down. I don't see a substantial decrease in the activity with respect to actual values coming down a lot. And I mean, the nice thing about the Bank of Canada not reducing rates or starting to reduce rates is at least I'm hoping I'll get invited back in March so we can talk about it again. But I think we're near the end on that. And I think that the market really has weathered very, very well with respect to everything that's going on.
Your job as a developer is to obviously understand what's happening near term. You plan for the long term. Does what the Bank of Canada is saying in terms of basically suggesting that they're done raising rates, does that give you as a developer, as a business leader, some certainty in terms of what to price into your models going forward, what projects to green light?
Yeah, for sure. But the interesting thing is that we are so overcautious now with respect to contingencies and how we carry our interest rates forward with respect to borrowing money from the banks that I think we're going to do substantially better from a profitability standpoint down the road. And I think that from a purchaser standpoint, they're going to also do very, very well. So I think it's going to be a good experience for everybody.
You're always optimistic, Barry.
Well,
I guess you have to be as a builder. If you build it, they will come.
No, in 20 plus years, I've been right. But the truth of it is that it's an asset that you can't really screw up. I mean, we need housing. We have lots of immigration. We have lots of people that need to live somewhere. And, you know, whether it's a 2% interest rate component for 5-year mortgage or 6 or 7, for sure it hurts. But at the end of the day, people try and figure it out.
Does the moves that have been made on the fiscal side, on the government side, did that change the picture for you as a builder willing to add to supply in the market?
It's frustrating because when I see what they've done, they did something like 10 or 11 turns to the upside with respect to the lending between banks on rates. So it's a problem because what they need to do now is they realize they're going to stop. So they now have to go down the ski hill. They have to say, okay, you know something, we're close to it. Let's start to bring it down gradually. Because what's going to happen is they're going to bring something down 2%, 2.5% on the cost of monies between themselves over the next year. And then they're going to say, oh.
But this is the banks. I'm talking about the government. You know, they made so many moves to try and incentivize builders like yourself. So that's on the rate side. But what the government has done to try and entice you, scrapping certain fees, does that help?
I mean, to be honest with you, first of all, when they suggest something to you, it takes about 6 years to implement. So we're really looking at futures, but we really need to look at it presently. So I've never really found that and we're grateful for what the government does, and thank you very much. But when you get a reduction of something that they help you on, they usually try and come back the other way and increase something. So at the end of the day, I don't rely on government assistance to try and figure out a way to look at our overall picture of how we make money and produce in the real estate game.
How are you thinking, Earl, about the housing component and how it will exert pressure on the Canadian economy?
Yeah, I look at it from a very simple perspective, and that simple perspective is supply and demand. So let's say the supply right now remains consistent. Demand is increasing because of immigration, and now I think it increases that much more on the margin because of this bond market rally. Lower interest rates means someone qualifies for a higher mortgage.
Yeah.
So it starts to raise the whole spectrum. I think we're basically going to be in a balanced market. You know, payments like individual mortgage payments are still going to be higher than they were, which controls things. But I would say I'm optimistic. I'm constructive. That is the best word. I'm constructive of the housing market.
You got to watch the unemployment rate too, though, and that's looking at 6%. Maybe it goes past 6%. That seems to be the deciding factor as to what people do with their homes, their ability to stay in their homes.
Yeah, but this is the important part about looking at the breakdown of the unemployment rate. Is unemployment rate going higher because less jobs are being produced? That has different implications than the unemployment rate going higher because more people are coming into the workforce. Because your total amount, your aggregate dollars, if you times everyone who's working times their paycheck, is increasing still. So that is supportive.
Yeah.
So you have to look at the breakdown of unemployment.
I mean, Barry, I know you're optimistic long term, but you must have seen a slowdown. Unemployment is up, the housing sales numbers are down, pricing is a little bit under pressure. There must be a slowdown in your neck of the
where we're
woods.
getting affected? It sounds interesting, but when we go out and hire forming contractors or drywall contractors or mechanical contractors, they have to go out and find hundreds of laborers to work with them. That's where we're having issues right now. Not so much from, yeah, for sure. Not so much from, we don't literally build the mechanical systems, but that's why prices are getting jacked up because it's taking longer to complete a job. And they're just not able to find the proper trade. Even though you hear about all these people coming into Canada, I think that what's happened is that whether interest rates, I think that one of the reasons people have, let me take it another way. People have just gotten a little lazy, I think. I think ever since COVID, I think people have a different dimension of how.
I don't know if they're lazy or they're tired.
Well, okay, I apologize, not lazy. Okay, so maybe they're weathered.
Yeah.
But the truth of it is, it's way harder to find people to want to do a job now than it was 4 years ago, 5 years ago. And
even if you're paying them a...
Oh, for sure. For sure. People think there's a certain way. I mean, if you go downtown Toronto, and we'd love to talk about the office market, the average group that comes into an office building by week is maybe 2 days. I'm sure all the banks tell the bankers, the employees, the same thing. So
well,
it's just a different
in theory,
mentality.
they're working at home in theory. But let's talk about the office since you brought it up. What are you seeing these days? There's a lot of people who say, listen, it's just being thrown out way too aggressively.
I think that is going to be the asset to acquire over the next 5 years.
Are you going to do that?
Well, we have some office buildings now. In fact, we have one great stellar office building right downtown that the Bank of Montreal is our lead tenant, and they've been great, by the way. We did a long-term sale and lease back with the bank many years ago. I think that market, what's going to happen is I think banks, and unfortunately, they're going to look at these assets. They're probably going to have to write them down based on the fact that there's no one coming into the shop, or people don't want to renew leases or whatever, or the rates. And I think that's going to be the opportunity now over the next 10 years to really capitalize on a problem we have right now.
And so when you say that's an opportunity over the next 5 years, is that to keep them as office or or would you look to do something else with
I
them?
think that the whole concept of people coming back to downtown Toronto, for example, or in New York, I track very, very deeply. And I think that what they're finding now is that some of those marketplaces, people are coming back. So what it is, it's an adjustment to price. But I think banks will also have to work with the buyers. And I think I think that's a really cool asset to want to try and take a look at.
And you'd be willing to do that here? You're not waiting for further signs of stabilization?
I think now is beginning to become a phenomenal opportunity.
All right. Thanks so much.
Together with high-rise condos and low-rise.
Yeah, of course. Barry, thank you.